Exercises 6-4 and 6-5 talk about what happens if somebody doesn't pay us. We send out an invoice and we don't get paid. Exercise 6-4 is the direct method. That's the only one we can use for our taxes, but we are not allowed to use it for our books. For our book purposes, we have to use the allowance method because generally accepted accounting principles require us to match our expenses with our revenue. So in the period that we make our revenue, we make our sales, we have to book an estimated amount of bad debt expense. So we're going to debit bad debt expense and credit some kind of reserve account or placeholder account or contra asset account, however you want to think of it. That's called allowance for doubtful accounts. And then as specific accounts receivable turn bad, we'll use up part of that reserve to write those things off. But before we talk about things going bad, let's talk about what happens when things go right. So let's pretend like January 1st we sent out an invoice for $54,000. Accounts receivable is an asset. Assets increase with debits, so we debit accounts receivable for $54,000. Revenue, or sales, or fees earned, or whatever our revenue account is, we're going to credit that for $54,000. Remember, that account keeps track of our sales, whether they get paid today, tomorrow, or never. So then let's pretend that on Valentine's Day they pay us. So we debit cash for $54,000. What's happening to cash? It's going up. Cash is an asset. Assets increase with debits. And we're going to decrease the account receivable for $54,000. All right, let's put in T account so we can see what's happening. Cash is going up and accounts receivable is going down. So now what's the balance in our accounts receivable account? It's zero. $54,000 worth of debits, $54,000 worth of credits. What's the balance in our cash account? $54,000. Notice that when we got the money, we didn't credit revenue again. That would be double counting the sales. We only count it when we send out the invoice. Okay, so now let's talk about what happens when things go bad. In exercise 6-4, it doesn't tell us so, but obviously sometime in the past, these guys sent out an invoice for $54,000. Then on February 14th, they get a $9,000 check and a note from the customers saying that they aren't going to pay them any more money. So what's happening to cash? Cash is going up. Cash is an asset. Assets increase with debits. So we debit cash for $9,000. That account receivable has a balance of $54,000. That's a debit. So to write it off, we're going to have to credit accounts receivable for $54,000. And in the direct method, we debit an account called bad debt expense. Okay, so let's post those just so we can see what's happening. Cash is an asset. Assets increase with debits. We're going to take that entire account receivable off our books because we're not going to get paid anymore. At least that's what we think at this point. And so now we have some bad debt expense of $45,000. Then on December 23rd, we get a check for $45,000 to pay us off. Well, the first thing we got to do, the account receivable balance is zero. So we got to put that account receivable back on our books. Accounts receivable is an asset. Assets increase with debits. So what we're going to do is we're going to debit accounts receivable for $45,000. And we have to undo that bad debt expense because it turns out it wasn't bad debt expense. He's going to pay us. So now we have that account receivable back on our books and we can receive the cash for that. How much did we get? We got $45,000. And now we can take that accounts receivable off our books again. We put it back on when we found out we're going to get paid, and now we take it off again when we get paid. So let's post those so we can see what's happening. Accounts receivable has a zero balance until we post this $45,000 on here. That's the remainder that that customer owes us. Bad debt expense will undo that $45,000 debit, so now bad debt expense has a zero balance, which makes sense because we're getting paid. And now we get to receive the cash. Cash is an asset. Assets increase with debits. So we debit cash for $45,000 and we take that account receivable off our books again. So now accounts receivable has a zero balance. Cash has that $54,000 balance and bad debt expense has a zero balance. Exercise 6-5 uses the allowance method, which is the one we have to use. We have to match our expenses and our revenues. So in the period we make our sales, we have to make an estimate of how many of those sales we won't collect. For example, let's pretend in this example, it doesn't give us this data, but let's pretend that we estimated our bad debt expense at $50,000. So we debit bad debt expense for $50,000, expense to debit, expense to debit, expense to debits, and we don't know which accounts receivable we should specifically write off, so we have to set up this allowance account, this reserve account, this contra asset account, this placeholder account, however you want to think of it, with a nice credit balance of $50,000, and we'll use that up as individual accounts receivable go bad on us. So 6-5 says on January 31st, let's pretend, by the way, that on January 1st we sent out an invoice for $40,000. And then on January 31st, we receive a check for $8,000 and write off the remainder of $32,000 as uncollectible. So what's happening to cash? Cash is going up. Cash is an asset. Assets increase with debits, so we debit cash for $8,000. We're taking that entire account receivable off our books that had a debit of $40,000. To make it zero, we're going to credit it for $40,000. So we need to debit something for $32,000, and what we debit is this placeholder account. In the direct method, we debit bad debt expense, but we don't do that here because we already booked the estimated bad debt expense earlier in the month. Okay, so let's post these so we can see what's happening. We have $8,000 worth of cash coming in. This account receivable comes off our books, and that makes sense because we decided that we aren't going to get paid, and we use up $32,000 of our allowance for doubtful accounts. We don't debit bad debt expense again because we've already booked that previously. Okay, so now suppose we do get that $32,000 later in the year. Well, what's the balance on accounts receivable now? It's zero. So we have to put that $32,000 back on our books. So we're going to debit accounts receivable for $32,000, and we're going to undo that $32,000 debit to allowance for doubtful accounts, because it turns out we didn't need to use up part of that placeholder account. Turns out the customer actually paid us, and they paid us cash. So we debit cash for $32,000. Cash is an asset. Assets increase with debits. Accounts receivable is an asset. It's going to decrease with a credit. So let's post these two journal entries here and see if that helps. All right, accounts receivable currently has a zero balance because we wrote them off before. So let's put $32,000 back on, and let's undo this $32,000 worth of using up the placeholder account. So now the balance in our allowance for doubtful accounts is back to the $50,000. We haven't used any of it up because it turns out this guy wasn't a bad account at all. And now that the account receivable is back on our books for $32,000, we can receive the cash for $32,000. Cash is an asset. Assets increase with debits. Accounts receivable is an asset, so it decreases with credits. So now what's the balance in our accounts receivable? It's zero. What's the balance in our cash account? It's $40,000. And we still have our allowance for doubtful accounts full up with $50,000 ready to write off future bad accounts receivable. So the two different methods are the direct method, which we have to use for our taxes. When a specific account turns bad, we debit bad debt expense. And the allowance method, in the period that we make our sales, we have to make a guess at how many of those sales we aren't going to collect. And that number gets debited to bad debt expense and credited to the allowance for doubtful accounts. And then we use up some of that as individual accounts receivable turn bad. Okay, I hope that helps. See ya.